Have you ever wondered why inflation, once it begins, seems to linger like an unwelcome guest, long after the initial causes have faded? Many people assume inflation works like a simple switch. Prices go up, conditions improve, and then prices come right back down. But historically, this rarely reflects the complex reality of economic dynamics. Once inflation takes hold, it often becomes incredibly slow to fade, embedding itself into the very fabric of our economic lives. If you've ever felt frustrated by persistent high prices or questioned why economic relief seems to arrive so slowly, this video is designed to explain this intricate pattern clearly and analytically. We'll explore the structural, psychological, and behavioral forces that make inflation so difficult to unwind, offering a deeper understanding for students, investors, policymakers, and the general public alike. Before we delve deeper, let's clarify the purpose of this exploration. This video is not about predicting future inflation or assigning blame to any single entity or policy, nor is it intended to create alarm or urgency. Our goal is purely educational and analytical. By the end of this discussion, you will possess a robust understanding of why inflation tends to persist once it begins. We will dissect the underlying forces that keep it in place, examining how this pattern has manifested repeatedly throughout economic history. This knowledge will empower you to interpret economic news more accurately, make more informed personal financial decisions, and better comprehend the complex challenges faced by policymakers. At first glance, inflation can appear deceptively straightforward. A common perception is that something specific causes prices to rise, perhaps a supply shock or a surge in demand. Then, once that cause dissipates, prices should logically stabilize or even decline back to previous levels. This intuitive model, however, often fails to capture the reality of economic systems. Inflation doesn't unwind as neatly or predictably as it often begins. Instead, what frequently occurs is a pattern where inflation accelerates quickly, then slows gradually, and finally lingers longer than most expect. This persistence is not accidental. It is a fundamental reflection of how modern, interconnected economies adjust and adapt to significant changes in price levels and expectations. It highlights the difference between a temporary price fluctuation and a more deeply embedded inflationary process. One of the most important distinctions for truly understanding inflation persistence lies in differentiating between price changes and absolute price levels. Inflation, by definition, measures the rate at which the general level of prices for goods and services is rising over a period. It tells us how fast prices are increasing, not how high prices already are in absolute terms. When we hear that inflation is slowing or disinflating, it means that prices are still rising, but at a less rapid pace than before. Crucially, it almost never means that prices are returning to their previous, lower levels. The absolute price level, once elevated, tends to remain elevated. This fundamental distinction explains much of the frustration and confusion people experience during periods of disinflation. While the data might show improvement, the cost of living remains significantly higher than it was before the inflationary episode began, impacting real purchasing power and household budgets. Another powerful reason inflation is so hard to reverse is embedded in the very cost structures of businesses and economies. Many critical costs that rise during an inflationary period do not easily fall back down once they have increased. This phenomenon is often referred to as stickiness in economic terms. Consider key components like labor wages, commercial rents, energy contracts, transportation costs, and financing expenses. Once wages are increased to compensate for higher living costs, they rarely move backward due to both contractual agreements and social norms. Similarly, once leases are renegotiated at higher rates, those elevated costs are locked in for the duration of the contract. Businesses facing these entrenched higher costs are naturally reluctant to lower their selling prices, as doing so would erode their profit margins. This upward rigidity in costs creates a powerful floor for prices, making a broad-based reversal incredibly challenging. History provides compelling evidence that inflation persistence is a recurring pattern, not an isolated anomaly. The inflationary period of the 1970s in the United States serves as a prime example. Inflation surged rapidly, driven by oil shocks and expansionary policies. Despite policy responses, which took time to implement and gain traction, inflation proved incredibly stubborn. Even after the rate of inflation eventually slowed, the elevated price levels remained, fundamentally resetting the cost of living for an entire generation. Similar patterns have been observed across diverse economic contexts globally. Post-war Europe experienced significant inflationary pressures as economies rebuilt. Latin American economies, during various stabilization periods, often grappled with entrenched inflation that proved difficult to extinguish. Emerging markets following currency devaluations frequently see inflation embed itself into their systems. Across all these scenarios, the lesson is remarkably consistent. Inflation is far easier to ignite than it is to extinguish, demonstrating its capacity to embed itself deeply within economic structures and expectations. Inflation also persists because it fundamentally alters economic behavior and expectations. When individuals, businesses, and investors come to expect prices to continue rising, these expectations become a self-fulfilling prophecy, reinforcing inflationary dynamics. Businesses, anticipating higher input costs, adjust their pricing strategies proactively, often raising prices to maintain margins. Workers, expecting their purchasing power to erode, demand higher wages, contributing to a potential wage price spiral. Consumers, in turn, may change their spending patterns, perhaps accelerating purchases to beat future price increases or seeking out assets that traditionally perform well during inflationary periods. This behavioral feedback loop can sustain inflation longer than anticipated, even if the original pressures that triggered it have begun to fade. This is precisely why central banks pay such close attention not just to current price data, but also to inflation expectations, as they understand that expectations shape decisions and decisions ultimately shape economic outcomes. Managing these expectations is a critical, yet often challenging, aspect of monetary policy. Reversing inflation aggressively, while seemingly desirable, carries substantial economic trade-offs and risks. Policies designed to rapidly reduce inflation, such as sharp interest rate hikes or severe fiscal tightening, can have significant and often painful side effects. These measures can slow economic activity dramatically, potentially leading to recessions and increased unemployment. Businesses may reduce investment, and financial markets can experience instability as borrowing costs surge and asset values adjust. Because of these profound risks, central banks and governments often opt for a more gradual, cautious approach to disinflation. This measured strategy aims to cool the economy sufficiently to bring inflation down without triggering a severe downturn. While this cautious approach can feel frustratingly slow to households and businesses grappling with persistent high prices, it reflects a deliberate attempt to balance the competing pressures of price stability and economic growth. It's a complex balancing act, not a simple switch to be flipped. To truly grasp inflation's persistence, we must adopt a more accurate and nuanced framework. Inflation is not merely a temporary glitch or a fleeting event. It is a complex, system-wide adjustment process that, once initiated, fundamentally alters economic relationships. During this process, prices across the economy reset to new, higher levels. Contracts for wages, rents, and supplies are renegotiated and adjusted to reflect the new economic reality. Crucially, expectations about future prices adapt, influencing current decisions. And finally, consumer and business behavior shifts in response to these new conditions. Reversing inflation, therefore, means gradually reshaping all of these interconnected elements, a process that inherently takes considerable time and coordinated effort. Understanding this framework does not in any way justify inflation or diminish its negative impacts. Instead, it provides a robust analytical explanation for its stubborn persistence, helping us move beyond simplistic narratives. This analytical perspective fundamentally changes how we interpret economic news and personal financial conditions. It explains why improvements in inflation data often feel agonizingly slow to the average person. It clarifies why relief from high prices arrives unevenly across different sectors and goods. And it helps us understand that price normalization rarely, if ever, means a full reversal to pre-inflationary price levels. Instead, it signifies a stabilization at a new, higher plateau. Furthermore, this understanding helps to remove the burden of personal blame. Persistent inflation does not mean individuals are falling behind because of poor financial decisions or a lack of effort. Rather, it reflects the inherent nature of how complex economic systems unwind slowly and adjust to significant shocks. For investors, it underscores the importance of considering real returns and inflation hedging strategies. For students, it provides a practical application of macroeconomic theory. For policymakers, it highlights the immense challenge of managing expectations and navigating trade-offs. Let's re-anchor ourselves to the core idea we've explored. Inflation is inherently difficult to reverse once it takes hold because of a confluence of powerful economic forces. Price levels reset to new, higher plateaus, but rarely retreat to their previous state. Key costs, such as wages and rents, become elevated and exhibit significant stickiness, resisting downward adjustments. Inflationary expectations adapt and become embedded in economic decision-making, creating a self-reinforcing cycle. Finally, consumer and business behavior shifts to reinforce these new norms, making any reversal a gradual and challenging process. Understanding these structural, psychological, and behavioral forces provides a more realistic expectation for how inflation fades. This deeper insight empowers us to interpret economic conditions more accurately, make more informed personal finance and investment decisions, and better appreciate the complexities of economic policy. Please like this video if you have enjoyed it or received any benefit from it. Every one of your likes truly encourages us to continue creating helpful content. Thank you for watching and have a blessed day.